Hey guys, welcome to this week's AECVC. So this week I'm going to tell you a secret little framework that we're using here at Fundamental and I've become quite fond of. And it allows founders as well as investors to think about what opportunities in the very early stages in architecture, engineering, construction and supply chains are worth pursuing and which are not, based on two very simple criteria that I apply. So watch the episode and I'm going to walk you through the framework. Hey guys, welcome to this week's AECVC with Hidden in Spite of Obvious Opportunities. This is all about a framework that I want to share with you that I apply to early opportunities that I invest in within the architecture, engineering, construction, and supply chain businesses. Let's start with agreeing on one first principle thing. B2B and especially the AECS sector has many nuances. And these nuances oftentimes require a company to choose a dedicated approach to unlocking value in the AECS sector. It's one of the reasons why, if you think of a lot of software categories that are out there, they don't necessarily choose AECS as one of the early verticals to go after if you're a horizontal software. And so that is because all the nuances that you can say plague our sector or that are actually beneficial for our sector oftentimes require a dedicated approach, because the horizontal or generic playbook, how you build a product, how you distribute the product, they don't necessarily oftentimes apply to the specific nuances of AECS. So that's the first observation. You don't see many generic softwares that go after the on-site software opportunities, the distribution opportunities, the supply side opportunities, the wholesaler opportunities. If you think about what actually in terms of generic software is being applied specifically in construction or AECS related workflows, you won't come up with many. Rather, you will come up with lots of examples that are dedicated to our sectors. And that's because of all these nuances. But the problem with nuances is, well, you need to know them. And you also need to know them not necessarily in order to have an answer, but actually what I've noticed is I need them in order to ask the right question. There are many anecdotes that I can share here about what kinds of questions and what kinds of nuances. I'll save that for a different episode. Instead, let me move to the framework. So if you agree with me that AECS has a ton of nuances, then you will like this framework. So what I'm showing you here is a framework where I'm differentiating between being a generic person into a B2B sector and being an expert or an early adopter in this sector. And a specific venture can be hidden or it can be obvious. An opportunity can be hidden or it can be obvious to a generic outsider person or to an insider like an early adopter or an expert. And in terms of when you're hidden to a generic person, but you're obvious to an early adopter, that's where you want to sit. That's the top right corner here. This is what I call hidden in spite of obvious. It's hidden for the generic people in spite of being obvious to early adopters or to the experts of the industry. That's where the diamond gets shaped. That's where you can build a category creating firm potentially, because you won't meet stiff competition in a short amount of time from a lot of generic founders and backed by a lot of generic investors. That's really the sweet spot category that as a founder and as an early investor, you would want to go after. The opposite end of the spectrum is obvious in spite of hidden. So it's what a generic founder or a generic investor would call, I'm too early because the customers are not getting it, or the experts are not getting it because perhaps I'm cloning a category from somewhere else, or I'm applying certain principles from a category that applied and I apply them to AECS and I wonder why is no one buying me? Well, it's because it's hidden to these customers that makes sense. So that's the category you absolutely do not want to be in. That's like the red zone here, right? So that's when you're obvious but hidden. Now, the two categories which require, again, nuance in itself, but they are not necessarily optimal, are if you're hidden to everyone. So intuitively you would say, hold on, if I'm hidden to everyone, perhaps that's not a good place to be in. That's mostly true, but it can be that you're just taking an ultra contrarian and high market risk opportunity. It could be that you are making certain assumptions about how the market inflects that the customers are not making yet, and the generic investors also are not making yet. If you're comfortable with such an immense market risk to take that bet, you could potentially be in for a real outlier outcome. Again, here the key though is that you're hidden to the generic investors. That allows you to be early. The other part of this framework where you can be right, but you don't necessarily control that, whether you're being right, is when you're obvious to everyone. So being obvious to both the generics as well as the experts and the customers means that either you have become obvious because you're already the category leader and you're relatively late in your journey. That obviously is a dream scenario. It's not what you can start with though. That's something that, perhaps a talent that wants to join a category leader can use as their framework. But for you as founding, or for me as an investor, I cannot come late. I need to be early. So that unfortunately is not what I can go after here. And then the other reason why you might be in that part of my framework is because you're a category clone. So everybody knows what the playbook looks like. Both the customers and experts, as well as the generics, you're trying to copy the playbook and you're applying it to a different part of the market, oftentimes a different geography. The problem with that is if it's obvious to you, it's obvious to everyone. And that includes also other follower competition that could come. And that is not necessarily a great place to build a generational company. So you want to be top right here, which is the hidden in spite of obvious framework. And so for that, in order to evaluate such hidden in spite of obvious opportunities, you're looking for signals. And so what I look for and differentiate and learned is that there's strong signals versus poor signals. And most of the people actually look at poor signals all the time. So when you differentiate strong versus poor signals, let's start with the poor signals. So oftentimes, the vast majority of the time, actually, people will take signals like how much fundraising has gone into a certain company and its model, or are the press releases particularly impressive? Those are really poor signals and also back-tested by time, especially in markets that allow a lot of fundraising, where you're not necessarily going after a winning model. You're just going after a model whose narrative has allowed it to raise a lot of money relatively quickly. But if you don't have insights into the cash flows, the P&L, what the customers say, etc., how do you know? Well, you're just taking a proxy that is flawed. Also, something that VCs like to do a lot is basically track how quickly is a team growing or how big is the team. Again, that's a poor indicator because if you grow to a large team, the law of diminishing return typically says that the average quality of your team is decreasing. And so again, that only means that you raised a lot of money indirectly, but it doesn't necessarily tell you that a lot of high quality people are vetting this opportunity for you, right? So growing team in quantity is a poor signal to use. And finally, something that you see in AECS every now and then is when companies fundraise or try to lure talent by saying, hey, I have all these contracts, but then when you look into it, they are call-off contracts. So basically, hey, I'm giving you a little bit of volume here. I'm closing almost like a frame contract for volume. But in the end, whether it gets called off goes through another process. It goes through another hurdle. So these in the end are what I call empty shell contracts, right? So they don't mean as much as you would like them to be, but it's cool if everyone can say, hey, I got a contract with this company. So these poor signals are signals that are obvious to see for everyone. And that refers back to my framework, right? So if it's obvious to see to everyone, most of the times it's a poor signal. The strong signals in the early stages where you need to pick as a founder or as an early stage investor like me, they are strong signals because they are not obvious in the early days and they are tough to get right. What do the customers buy? What do the early adopting customers say? What do suppliers on the platform? Why do they join? I need to talk to them. I need to understand, again, the nuances that made them go here. What is the P&L? What is the cash flows looking like? One of my best investments was an investment that literally in the pre-seed, every other investor passed on, every generic investor passed on, but they were net profitable. They had terrific P&L and cash flows. Everybody passed because they were a service business. Now they're a software company. It was really obvious once you had the signals and you knew what to look for, but they didn't have strong fundraising. They didn't have a big team at the time. They didn't have lots of press, PR, etc. It was just the heuristics that made people pass. But the cash flow and the P&L was exceptional. And then finally, if A+ talent is coming into a company, not in quantity, but in quality, that also speaks as a very strong signal, because that usually means high quality people only dedicate their plan A to a company after a rigorous diligence process. So these are all strong signals that you would look for, and because they are hard to get, they are valuable. That's what makes you actually vet whether an opportunity could be hidden to generic people but obvious to you. And that's a great part of the framework to be in, right? Now, to do that, oftentimes in AECS, empathy matters. So one of my main benefits as being a vertically specialized investor like others of my peers is, because we dedicate, we get to see the same thing over and over again, and the routine breeds empathy. It allows us to ask certain questions earlier than others. It allows us to know our unknowns, and knowing the unknowns makes you formulate the question. Whereas if I were to look at a biotech deal, because I don't have routine there, I won't even know which questions to ask. And that's what happens to generic investors very early in AECS. So this empathy that comes with background and routine helps a lot. And that's also the same for founders who want to break into AECS. It doesn't mean you have to come from AECS. In fact, quite the opposite. I would encourage you to look into AECS because you don't come from it, but you need to dedicate the time to build the empathy, talk to people like us, talk to a lot of customers, to a lot of suppliers, and over time, learn the nuances of this industry, because it will allow you to do the right things. Something that my portfolio company Monumental, for example, did, which is robotics for construction. They dedicated a year before committing to it in order to look into construction as much as possible. So my call to action for founders in AEC is, again, follow my framework, look for hidden in spite of obvious opportunities, dedicate your time to strong signals and build empathy. And I have to give a shout out to my wonderful partner, Shoop, here seen with an amazing Photoshop crown on top of it, because he actually gave me the inspiration for the hidden in spite of obvious framework. So thanks, Shoop, very well done. And guys, I see you around next time. Hey guys, thanks for tuning in. Make sure that you subscribe under aecvc.com, and you can also find me on LinkedIn. See you next time.